63 frickin' banks are on the brink of collapse in America. Is America facing a banking crisis? Well, in a shocking new report, the U.S. banking industry recorded a mind-blowing $517 billion in unrealized losses in Q1 just alone. That's over $500 billion fricking dollars. Just a pretty damn big number in case you need to know that. But before you shrug this off, oh, more fake news, more bullshit, big old fat nothing burger. Well, this report has come from none other than the insurers of your bank deposits themselves, the FDIC, or the FDIC, as I like to call them. So if they're sounding the alarm bells, does this mean that it's the start of yet another financial meltdown, yet another financial crisis? It all gets so tiring, doesn't it? Look, now is not the time to ignore the warning signs. Even if the mainstream media is trying to bury this kind of news, it's important for you as an investor to know about it. So in this video, I'm going to break down exactly what the heck is happening right now in the banking system and what could happen next, most importantly. And stick around till the end of the video, of course, to find out what you can actually be doing as an investor to try to prepare for this situation. So first of all, let's talk about what the heck is even happening out there, man. It's pretty crazy news. You see, the U.S. banking system is suffering from an unrealized loss problem. The FDIC, the FDIC, subtly slipped the bombshell news into the first quarterly banking profile report of the year. Unrealized losses are on the rise, and they have increased by $39 billion from previous quarter up to $517 billion in Q1 of this year. Unrealized losses, these are the difference between the price that you paid for an asset and the asset's current market value. Okay? This increase in unrealized losses has actually stemmed from the residential real estate market. Higher mortgage rates have essentially seen bank assets like mortgage-backed securities plummet in value. Now, this is actually the 9th consecutive quarter of what the FDIC has called unusually high unrealized losses. So the banking system is suffering from interest rate risk, with the Fed having hiked interest rates since Q1 of 2022, and it is now keeping them at peak levels for longer. The value of the bank's assets are losing a lot of value on paper. They might be thinking, well, if they're unrealized losses, then all the banks need to do is just, well, hold until the value of those assets just goes up, right? Simple. Just like I do with my crypto bags. Well, as you know, there's a fractional reserve banking system. So your bank deposits, they aren't really sitting there in physical cash, are they? No. Instead of holding cash, what commercial banks do, they go out and they buy mortgage-backed securities. And they're currently holding around $5.47 trillion in bonds. And that's because they're supposed to be risk-free assets, of course, backed by the faith in the U.S. government. But the problem with bonds is there are different types of bonds with different maturity dates. Some have a maturity date of, just a few months. Some have a few years, some a few decades. Right now, the unrealized losses on these investments, whether it be in bonds or mortgage-backed securities, are greater than back in 2008 when the financial crisis hit, and by quite some margin. So look, the banks have your money. They just don't have it right now, okay? As long as the banks hold to maturity, in theory, there should not be any kind of problem. But theory and reality are often two different things. You see, there's a big percentage of these assets that are available to sell before they reach maturity. The problem comes when the banks are forced to sell at a loss. Okay, when too many people go and demand their money back, banks have to sell these things for a loss. Banks have to eat that. That's the $500 billion time bomb, why the FDIC has declared that 63 banks are on the brink of collapse, because they're the ones facing these historically big losses. But before I discuss what could happen next, I want to interrupt the flow real quick to let you know about the best damn newsletter in the cryptocurrency business. It just happens to be my newsletter. It's called Wealth Mastery. I know I'm biased, but guys, it's awesome. Our readers love it. I'm sure you will too. Every week, my team and I are bringing you the latest, the greatest, the freshest, the sweetest opportunities and insights in the cryptocurrency market. We talk airdrops, meme coins, altcoins, deep dives, NFTs, technical analysis, and much, much more. You can join our 125,000 plus weekly readers for free using the link down below in the description or the pinned comment over on X. Thank you very much. Let's get back into this and let's talk about how the house of cards could all unravel. You see, the more unrealized losses that pile up, the bigger the financial burden that this actually puts on the banks and on the Fed in the end, because they're backstopping all of this with their loan programs. Now, if any of these banks needed to raise cash quickly, of course, they're then forced to turn these paper losses into real losses. And right now, the Fed's backstopping that. But for how long? And then it becomes the Fed's problem and your problem as the taxpayer. When the burden of interest rate risk gets too much, of course, they could eventually lead to a liquidity risk. The FDIC themselves have said that inflation, interest rates, and geopolitical uncertainty, and there's been a lot of that recently, all act as liquidity challenges. That's a nice way to put it, isn't it? And this is exactly why the Federal Deposit Insurance Corporation, the FDIC, exists in the first place. Okay, I know it's not called the FDIC, all right? It's just funnier. Anyway, they're the company that insures U.S. bank deposits. So in case a bank fails, customers are paid back up to a certain amount. Currently, that amount is set at $250,000. While the FDIC says that the U.S. banking system is at no immediate risk, that doesn't actually mean that there isn't any risk at all. You see, the number of problem banks, it's actually on the rise, having increased by 21% from 52 in Q4 2023 to 63 in Q1 2024. And as long as interest rates remain high like this, that problem is going to keep getting worse. But whilst it sounds like a lot, it's still well below levels seen during the 2008 financial crisis in terms of total numbers of banks. So when we think of the U.S. banking system, we tend to think about the too big to fail banks like JP Morgan and Wells Fargo and Bank of America, the big fat cats, right? And whilst the financial system is, of course, trying to consolidate the banks, there are still literally thousands of banks out there in the USA. So who are these 63 problem banks? Well, they're not actually being named, which is kind of weird. Course, they don't want you to go rush in and take all your money out of those banks because that would cause a bank run and cause more problems for the Fed. Okay, it becomes a self-fulfilling prophecy at that point if they name them. Customers panic, and it's a mess. That's basically the scenario. Okay, and that exact same scenario played out last year with Silicon Valley Bank. They invested in bonds with long maturity dates, but they didn't plan for interest rates going up. And then they started racking up massive unrealized losses after Silicon Valley Bank collapsed. That's when the Fed put in this backstop program. Now, the bank was then forced to sell $1.8 billion in bonds at a loss. When words started spreading on social media that Silicon Valley didn't have your money, all it took was 48 hours for customers to withdraw all the physical cash that it had. There was a massive bank run that started happening. Without knowing who these banks are, of course, we have no idea just how much money in customer deposits is actually at risk here, okay? And if you think the FDIC is going to save you, sorry, honey, think again. The FDIC also buried in the bottom of the report the absurd fact that its insurance fund only holds 1.17% of all U.S. bank deposits. They ain't got your money either, which means if one large bank or multiple smaller banks began to fail, then there isn't going to be enough money to make every customer whole. Not without the Fed stepping in, probably printing money, all those shenanigans that seem to happen all the time. So what should you do as an investor? Firstly, you got to watch out for an increase in liquidity levels. When there's trouble in the financial system, the word gets out and the world gets into government bailout territory. So just a week after the banking crisis unfolded in March 2023, the Federal Reserve launched, of course, as mentioned, a temporary credit line to banks called the Bank Term Funding Program in order to make sure that no more banks collapsed. So then over the following 12 months, around $165 billion of liquidity was actually injected into the financial system by banks using this program. Financial markets like the S&P 500 and the NASDAQ, they were trending down going into to the banking crisis. Then, of course, what happens? The bailouts sent the markets into a big rally. In 2023, the S&P 500 was up 24%, the NASDAQ was up 55%, and Bitcoin, which is even more volatile, was up 156%. So make sure you position yourself on the right side of the liquidity bailouts, okay? And whilst your cash in a collapsing bank may be recovered, if they don't all collapse at once, it just ends up being, of course, by lost value due to bailouts. Spare cash is better in assets than in at-risk banks. And secondly, you've got to protect your wealth by holding assets outside of the dollar-denominated financial system. So maybe you want to own some commodities, a little bit gold, a little bit of silver, maybe something like that. Or, of course, my favorite pick, Bitcoin. Bitcoin's the answer, guys. Of course it was gonna be. Come on. And look, remember that just because there was a banking crisis before, it doesn't mean that the next financial crisis will be triggered by the exact same event. It just means they're at risk. Now, history doesn't repeat, but it sure does rhyme. And the question you have to ask yourself is that if it does rhyme, do you want to find yourself with your pants down? The 2008 crisis was triggered by a credit risk event with defaults on mortgages. The 2023 banking crisis was triggered by interest rate risk. So who knows what will end up being the next big trigger? But there will be a trigger. There always is. At some point, the problems bubbling away under the surface, they rise to the top. It always happens. And you got to be prepared for that. Hopefully, it just waits another 12 to 18 months. We can have a sweet ass bull run and we'll get real rich and then not have to worry about it so much. Anyway, let me know what you think. Do you think another bank crisis is coming? Hit me up down below. Thanks for watching.